This lecture is the third part of Chapter 2. Liabilities and stockholders' equity will be covered, and the corresponding pages in the textbook are from page 64 through page 76. Liabilities are claims against assets or debts that the firm owes to others. Liabilities are categorized as either current or non-current liabilities. Current liabilities are those debts that must be satisfied in 1 year or operating cycle, while non-current or long-term liabilities are those debts that will be satisfied in more than 1 year or operating cycle. Current liabilities that are most commonly found on a firm's balance sheet include accounts payable, notes payable, current portion of long-term debt, accrued liabilities, and unearned revenue. Let's review these accounts. Accounts payable occur because suppliers offer short-term credit to firms. Unless the firm is late in paying their bills, this is free credit for a firm. Short-term debt, also referred to as notes payable, differ from accounts payable because there is a legal signed note and the firm will pay back principal and interest based on the contract signed. Current maturities of long-term debt are the payments on long-term debt that will be due in the upcoming year. For example, a firm that has taken out a 30-year mortgage on a building would show the first year of payments as current maturities of long-term debt, and the other 29 years of payments in the non-current liability section of the balance sheet. Accrued liabilities are conceptually similar to accounts payable, but often there is no invoice or bill for the expense. For example, firms generally recognize salaries expense when employees work for them, but do not necessarily pay those employees as they earn their wages. A firm will record an accrued compensation liability when they record the salaries expense, but the actual payment of salary to the employee may occur much later. Another type of accrued liability is called a reserve account. These accrued liabilities are set up to estimate obligations which may or may not actually cause an expense or loss of cash. Firms that sell cars, for example, will estimate the warranty expense at the time each car is sold. An accrued liability is set up as well, but the car may or may not need warranty work in the future. Anytime a firm is estimating amounts for reserve accounts, there is room for the company to manipulate amounts shown on financial statements. These accounts should be scrutinized by analysts. In fact, we have already discussed an account that is a reserve account, even though it is not a liability account. The allowance for doubtful accounts in the assets section is a reserve account to estimate bad debt expense. Unearned revenue is often labeled on the balance sheet as a deferred credit. This account is created when customers pay in advance for products or services. Once the firm delivers the product or service, the dollar amount is removed from the liability account and recorded in the revenue account. Deferred taxes can appear as both an asset or a liability and either as current or non-current. Deferred taxes arise because GAAP, generally accepted accounting principles, and tax laws are not the same. Complex accounting rules are used to determine amounts recorded in the deferred tax accounts. A common example of deferred taxes occurs when a firm uses straight-line depreciation to determine depreciation expense on the income statement, but uses an accelerated method to determine the tax deduction for depreciation expense on the tax return. This accounting topic is beyond the scope of this course, and you will not be held responsible for understanding the technicalities of deferred taxes. There are many forms of long-term debt. Each of the types listed on this slide are defined on page 70 of the textbook, so be sure to read and learn about the differences in these forms of debt. Capital lease obligations are a type of long-term debt that have arisen because of a FASB rule. When a firm leases property, plant, or equipment, and the lease is essentially equivalent to a purchase, the FASB rules require that the firm record the lease as if the firm purchased the asset with debt. The debt in this case is labeled capital lease obligation to distinguish it from other types of debt. When a firm has a line in their liability section of the balance sheet labeled commitments and contingencies, there will be no dollar amount listed. This is because the SEC requires firms to draw attention to important notes to the financial statements. The analyst should read notes about commitments and contingencies because these items could have significant financial impact on the firm in the future. Commitments are contractual obligations that must be paid in the future, but do not appear as debt on the balance sheet. The term off-balance sheet financing refers to such commitments. Enron had many items that fell into this category. Had readers of Enron's financial statement notes investigated the disclosures that were made, they may have realized the potential for bankruptcy well before it occurred. The commitments discussed in these disclosures were part of the reason that Enron went bankrupt. Contingencies refer to potential liabilities, such as lawsuits. This is another area that should be analyzed when trying to determine the future financial health of a firm. The final section on the balance sheet is the stockholders' equity section, sometimes called shareholders' equity. The dollar amount of stockholders' equity is equal to assets minus liabilities and represents the residual interest of the owners in a firm. A key account found in the stockholders' equity section is the common stock account, sometimes referred to as capital stock. The way an investor becomes an owner of a publicly held corporation is to purchase a security, common stock. Ownership in a firm allows the investor to vote on key issues each year. The owners earn a return on their stock if the stock price increases and the owner ultimately sells their ownership interest. A second way that an owner can earn a return on common stock is if the firm pays dividends. The board of directors of a firm decides each year whether or not to pay dividends. Some firms have never paid a dividend, while other firms pay dividends yearly. The par or stated value of the common stock is for accounting purposes and has no significance with regard to the actual market price of a firm's stock. If common stock has a par value of $1, then this just means this is the lowest price that the firm can sell stock for, but the actual amount that common stock sells for on the stock exchange is an amount determined by supply and demand of investors choosing to buy and sell stock. For accounting purposes, when stock is sold by a firm, the firm records the amount received in two accounts, the common stock account and the additional paid-in capital account. For example, if $1 par value stock is sold for $10 per share by the firm will include $1 of the price received in the common stock account and $9 in the additional paid-in capital account for each share sold. Firms sell stock when they first go public or if they later need additional financing to run the firm. Otherwise, all stock sales are between parties unrelated to the firm. If, for example, I own 100 shares of Intel stock, I could sell those shares to another person that wanted Intel stock. Intel is not involved in the transaction, as this is a secondary transaction. Intel would not receive any money and would therefore have no transaction to record. Retained earnings is another important equity account. The amount recorded in this account is the sum of all revenues, less all expenses, and less any dividends declared by a firm since inception of the firm. This account represents the total profits of the firm since it started in business, less any dividends paid to owners. It does not represent cash. Only the cash account represents the amount of cash that a firm has available. At the end of each year, a firm formally records an accounting entry in their books that moves the revenues and expenses, or net income, into the retained earnings account. Dividends are not expenses, but a separate equity transaction representing a return of capital to the owners of the firm. Dividends are deducted from the retained earnings account, as the dividends paid will no longer benefit the firm. It is money given back to the owners as a reward for their investment in the firm. Other equity accounts that may be found in the equity section are listed on this slide. I will discuss two of the items, preferred stock and treasury stock. The other two items are higher level accounting topics that will not be addressed in this course. Preferred stock is another way for investors to invest in a firm. Generally, if preferred stock is purchased, the owner of the stock has no voting rights, but usually is guaranteed a fixed annual dividend payment. Many firms also have a treasury stock account. This represents the amount paid by the firm to repurchase their own shares of common stock. The amount is a deduction to the stockholders' equity total on the balance sheet. Firms may choose to repurchase their own shares of common stock in order to send a message to the marketplace that they feel their stock is undervalued. The firm may later sell those shares again to make a profit. Sometimes the firm repurchases their stock to use for employee stock option plans or because they want to remove control from hostile investors. When analyzing any financial statement, it is important to assess the quality of the financial reporting. As already discussed, analyzing accounts such as accounts receivable and the allowance account allows an analyst to gain insight into the quality of financial reporting. In addition, it is important to analyze the quantity of liabilities both on and off balance sheet. Reading the notes to the financial statements can shed light on many important items that can help the analyst assess the financial position of the firm. A final note, although we have gone over key accounts found on the balance sheet, companies may have other accounts particular to their firm or industry that we have not discussed.